Hello, I'm Miriam Hipolito, your friendly Forex and crypto expert from Traders Union. Welcome back to our channel. In today's video, we're diving into one of the most useful but often overlooked indicators, the ATR, or Average True Range. If you're looking for a way to measure market volatility and manage your risk, this is the tool for you. So, let's get into it. The ATR was introduced by legendary trader J. Wells Wilder, and it's been a go-to for traders ever since. But what does it actually do? The Average True Range measures market volatility by calculating the average movement of an asset over a specific period. Simply put, it tells you how much price typically fluctuates during a set time frame, whether it's 1 day, 1 hour, or even a minute. Volatility and risk management. Okay, now the question is, how can we use ATR to trade smarter? Traders love this indicator because it gives clear insights into volatility. A higher ATR means the market is more volatile, while a lower ATR suggests things are pretty quiet. This information helps us with position sizing and setting stop losses. For example, if the ATR value on EUR USD is 50 pips, it might not be wise to set your stop loss at 20 pips. That's because you'd be betting the market won't move as it usually does. Risky business, right? Instead, ATR helps adjust your stop loss to match the market's rhythm. One pro tip: ATR doesn't tell you the market direction. It only measures volatility. So it's best combined with other indicators like moving averages or RSI for a more complete strategy. That's a wrap, friends. If you found this video helpful, hit the like button, subscribe for more trading tips, and comment below. Do you already use ATR in your strategy, or will you give it a try? Thanks for watching, and I'll see you in the next one.